Well, welcome everyone. This is going to be an absolutely amazing seminar. You'll be laughing, crying. It'll be absolutely pivotal in all of your lives. No, just kidding, kind of. So thanks so much for taking in the session. So a couple of things before we get started. This is a bit of a beta test in the sense that we want to more formalize the content for future delivery for younger investors and people embarking on their financial journey. So your feedback on the presentation would be really appreciated. So don't hesitate to do that in a follow-up email. We'll try to take questions as we go through the session tonight as well. There's a fair amount of content here, so we'll try to get through as much of it as we can. I will be taking breaks every half hour for about 5 minutes. And like I said, we'll be recording this session, so everyone will get a link to the video of this particular program. So you'll have a reference point for the content, and we'll divide the content up in different sections. So you can go to each of those sections very quickly if some sections don't interest you. The last introductory comment I'll make is we're going to be, all of us are in a different journey in terms of the financial information. For some of you, it's just the very beginning and you're going to feel way over your head in terms of the content. That's okay. The more times you're exposed to this information over time, the more comfortable you'll be with this content. So this is a bit of a learning journey. And so it's great to have you here. And this is the beginning of that journey for you. For some of you, you know a lot of this stuff. So it might be just a reminder of things you already know. And hopefully for all of us, we'll learn something new as a result of taking in this presentation. Now, Milan's going to monitor the chat function. So if you go to the bottom of your screen, you should be able to activate the chat function if you have questions as we go through. I can't see it easily on my screen as I go through the presentation, but Milan will monitor that. And our outline for our discussion today is basically, like I said, 5-minute breaks every 30 minutes. I would encourage you, if you have a piece of paper and a pen or a notepad, just take down notes on those things that either are of interest to you, you learn something new, or even questions for follow-up. I think there's a little bit of interaction as we go through it together. You'll learn a little bit more by doing that. So like I said, we're going to be covering off some material that you wouldn't normally think about in terms of financial planning and investment planning. But for younger investors, I think it's a really critical part of this seminar content. So anyone between the ages of 16 and 30, these are really critical things to keep an eye on when you think about your financial planning. So the first thing I'm going to focus in on when it comes to this area is when you think about all your finances going into the future and your ability to build wealth and to generate cash flow, one of the most important things that you need to focus on is cultivating trust. And that really is the currency of personal and financial health. Everything you do, if you talk to people ahead of the curve from you in terms of their careers, they're going to tell you that it's that ability to build trust, for people to have confidence in you, to trust you, is absolutely critical in your financial life. So it's not just in your personal life, but in your financial life. It is your ability to work with relationships and other people to get things done. And the currency of trust is critical in that will have a very big impact on your financial trajectory over time. So my kids I think, are sick of me talking about the 4 habits of trust. But if you master these 4 things in your work and business life, your financial life, they will supercharge your effectiveness. They're very small, little things, but they're actually critical things. So if you just do these 4 things, number 1, show up on time. Right? It shows great respect to people when you respect their time and show up on time. The second thing is you want to make sure that you finish what you start. So if you start a project for someone, do your absolute best to make sure you finish that project. So anything you start, make sure you finish. Do what you say you'll do, so follow through on your commitments, and say please and thank you. Those are simple things, but when you look at your relationships in your life, all of us will sometimes get, snagged with one of these. Sometimes it's because we have good intentions, right? We make commitments to people, we intend to follow through, and then life gets really, really busy. And so what I would say is when you make a commitment to somebody, people understand that life happens, but it's very important that you go back to that person and renegotiate that commitment. They'll understand. But what they won't understand is if you don't renegotiate it and go back to them, and then they're wondering, are you going to follow through? So if you can, to the extent that you can do each of these things in your relationships, you will foster trust, and that will have a very big impact on your financial lives. The next thing is you want to make sure you focus and come to understand over time what your unique ability. So those of us who have the ability to understand what is it you are passionate about, what is it that you do really well, what is it that you get lost in? You start working on it and a day goes by and you all of a sudden you go, holy smokes, where did the day go by? You were so immersed in that activity. Are there things that people say to you that you do well? So another part of finances is trying to understand what your unique ability is, because it dramatically impacts your financial future. One of the great things about careers is if you can find your way into work activities that use your unique ability, that's a really important part of financial planning. But it's also very important as it relates to just job and life satisfaction. And that happens early in your career. So ultimately, your finances will be driven off your unique ability, understanding what your strengths are, and delegating the rest. Okay, so not everyone is in a fortunate enough position to be able to do that, but that is the ideal goal, that you have the ability to work out of your core unique ability, your giftings, your passion, and then build people around you to help you work out of that unique ability. And then I have a strong bias about this, and not everyone agrees with it, but there is a view out there that increasingly our world is going to be driven by entrepreneurial companies. It's going to be driven more by entrepreneurs than by traditional businesses, government agencies, that kind of thing. And so you look at a lot of successful businesses are driven by entrepreneurs working out of their unique ability and using people who are supporting them out of their own unique abilities to help move that entrepreneur. So one of your goals, I think, should be is understanding your unique ability and how you can get on the coattails of great businesses, great entrepreneurs, great people who are making things happen, and figure out how you can use your unique ability to help that entrepreneur or business go forward and be successful. And that, to me, I think that's the future of life and work. It's no longer getting a government job or working for a large organization or, hoping that your financial futures can be looked after by some entity. You need to use your unique abilities, piggyback off others who are ahead of you, and help them facilitate what they need to be successful in business. And if you're interested, there's some great books that talk about this whole idea of unique ability. And then probably one of the last things I'll talk about in terms of this topic is be a goal setter. Always try to find ways that you can attach specific goals to things you want to do in life. Goals change all the time. They're just a way of creating some benchmarking and helping us to propel in a certain direction. To be successful financially, you need to be a goal setter and you need to review your goals. So there's often this SMART short form for goals, which is the goals have to be specific, they have to be measurable, they have to be achievable. You don't want to have goals that are so hard to achieve that you just get frustrated and stop going after them. They need to be tough enough that it creates some momentum and a little bit of struggle, but if you put the work into it, you're going to achieve them. They have to be relevant to what your big picture planning is, and they need to be time bound, very specific time frames for those goals. Now, there's all kinds of books written about goal setting, but I think that you want to make sure that you don't disconnect investment planning and financial planning from the fact that you need to have some specific goals. What are you trying to achieve financially? It's going to be very different for you right now at your point in life, but as time goes by, it'll change and morph, and you always want to be a goal setter when it comes to your finances. And then the last thing I'll say about these skills is a critical work and life skill is public speaking. For some of you, as soon as I say that, you freeze up, right? But if you look at a lot of successful people out there in work and life, they've really cultivated the ability to be good at communicating publicly. It doesn't have to be in front of big groups, but in a group of 3 or 4 people. your team that you work with or the team that you work for. If you've got a great idea or you have to convince your team of something, you need to really work on your ability to communicate publicly in written form. A great start, I think, for young professionals and people in the workforce is join a Toastmasters program, learn how to do public speaking, to communicate. I think is an absolutely vital skill that you need to hone and work on as part of your overall financial planning, because it'll have a big impact on your future success financially. And I know finance is not the only thing, but that's the topic here today. So that's really important. And then you want to look at your capital accounts. So again, we'll get into specific investments, but again, look at your life as sources of capital. So you have your unique ability to capital. To the extent that you focus in on that, you'll have more opportunities going forward. You'll be more effective. You'll be happier. Your trust building capital, focus on those 4 things that I talked about. Your relational capital, relationships are critical. And you talk to anyone that's been successful financially, they had a great ability to work with people, work for people, and to lead people relationally. It's a critical skill. And then education and training capital. Lifelong learner, doesn't stop when you finished high school or university. You're always learning, always developing. And then your health capital. You need to focus on your health because that's where your energy and your cognition comes from. Those are supercharging everything that you're doing. Okay. So when you're young, you take a lot of these things for granted, particularly the health capital, but you need to make part of your ongoing planning. How do I maintain my health? How do I keep myself from getting overwhelmed in those various areas? So these capital accounts ultimately will help you to grow cash flow. And ultimately, your cash flow is what's going to help you to accumulate assets and build your future financially. Okay. So if I had to summarize those things, here's a pyramid for financial planning, which looks very different than most financial planning pyramids, but I think it's relevant for your particular circumstances. So at the bottom here, we've got relationships and actually giving back as at the base of this financial pyramid. Why is giving back important? It reminds you of what you have, whether it's your local church or community activities or environmental activities, those things that really excite you, where you're making a difference. And it's not just about making money, it's giving back your time, your energy, and resources. And you should make that a part of your overall planning. It really helps you to understand where you come from. It helps to cultivate gratitude about the opportunities we have. And I think we all have a responsibility to give back in our own way. We talked about the importance of relationships, education and health, master trust building, and then master cash flow, which we'll talk about. Cover off risks. At your ages, as you go into the workforce down the road, the chance of disability or critical illness are the 2 biggest risks that you would face. Premature death is not one, but your interruption of income because of disability is actually a real risk in your futures. And so as you begin to develop your financial planning, you want to focus on making sure that you have proper coverages to cover off disability. Pay yourself first. We'll talk about that in investment planning, proper use of debt. And then for some of you, being an entrepreneur or using your unique ability to help entrepreneurs achieve their goals and working collaboratively with an entrepreneurship team. And then goals and reviewing your goals just happen all the time through this pyramid. So when we look at cash flow generation, let's talk about cash flow. Cash flow is going to be, it can go to assets, it can go to debt. There's good uses of debt and bad uses of debt. And a lot of our cash flow ultimately is going to go to lifestyle. The grand balance in financial planning is trying to balance lifestyle. We all have lifestyle aspirations. There's things we want to do. That's a spice of life, whether it's travel or hobbies or entertainment. All those things are an important part of life. While we're doing that, we're trying to balance it off with making good financial planning decisions. So everything's driven off our ability to manage our cash flow. So cash flow, for some of you may not even have jobs yet. So as you begin getting jobs, these are the things that you want to begin focusing on. Is before you get too far into your career and your work life, make sure that you're beginning to pay yourself first. Before you pay any bills, make sure that you're setting aside, whether it's 2% or 5% or 10% of your income, into savings or investment accounts. That's a really important skill to start early and to make that part of your month-to-month, year-to-year discipline, so that before you spend that piece on lifestyle, you've already got it baked into your planning. Build margin in your budget. Don't spend it all. Make sure you've got some reserve in your cash flow, and then monitor your expenses. Budgeting is part of that, but also just knowing where the money's flowing. And there's all kinds of great apps out there that will help you do that. One is Mint that's out there, will attach to your bank accounts. But the basic idea is pay yourself first, build margin into your planning. Don't start committing your cash flow before you've got control of it. And these are just 3 things to begin thinking about. And then we get into the topic of credit. And you guys are going to be increasingly looking at that area as you get older. And there's good uses of credit and bad uses of credit. And we'll talk about that right now. So a good use of credit is if you're using loans or credit to purchase appreciating assets. A classic example would be your home, right? A principal residence. Another good use of credit would be buying a business or growing a business or starting a business with the potential of, generating income and wealth for you over time. And then improving income potential through training and education. So I think there's an argument for all 3 of these things as being good use of credit, where you get money up front to be able to do the investment, with the idea that that will propel the enterprise and develop cash flow and wealth for you over time. Now, this is not a tax seminar, but one of the benefits of sometimes buying appreciating assets like stocks or real estate or business assets is you can write the interest costs attached to those loans off against other sources of income on your tax return, right? So there is incentive within the tax code to do that, to leverage off the bank's money or the credit union's money to get into asset purchases to improve your ability to accumulate wealth. So something just to be thinking about. So we look at cash flow. Ultimately, if you take some of your cash flow and get a loan, that's what we're talking about right now. There's 2 kinds of loans. There's loans that people do for lifestyle, cars, trips, and stuff. And then you've got loans that could be used for asset acquisition, real estate, business, stocks, training, income, education. To the greatest extent possible, you want to use debt to do things on this side of the balance sheet. And if at all possible, don't use debt to do the lifestyle piece. Now, the reality for things like cars, it's pretty common to build a sinking fund into your cash flow or getting a car loan or a lease payment. Car payments, whether you're saving for a car or just paying for a car loan, are a pretty common part of life. But ultimately, you want to watch the lifestyle piece. So what gets in the way of people's financial progress is they're spending too much money on lifestyle loans that keep them from really using their ability to borrow on appreciating assets. So something just to be mindful of. The best time to be mindful of these things is before you start making financial commitments and think through the implications of those financial commitments. So let me give you one example of what I mean. So this is just a simple financial calculator. Let's say that we were buying a house and we had to take out a loan for $300,000 to finalize the purchase of that home. So we do that, and let's say the interest rate on that mortgage loan is 4%, and it's being paid for over the next several years, 360 months to be exact. So it's a long-term loan, 30 years. And if you look at the cost over time, if interest rates never changed, the total payments were $515,000 for that $300,000 loan, and you incurred interest costs to the bank of $215,607. That's the interest you paid by going with a long-term loan. Let's say you try to get that loan paid off more quickly. Now we're having 180 payments, and your total cost was $399,431, and interest costs were $99,431. So by trying to accelerate the time at which you had paid off that loan, you actually saved yourself $116,000 over that time period. Or looking at the other way, if you extended that loan payment over the 30-year period, that home cost you $116,000 more, right? So that's one of the basic principles of debt management, is trying to shorten up that term for that loan. That will reduce your interest costs. It's really important to be mindful of that. Now, when you have appreciating assets like a home, you may not be quite as concerned about how quickly you pay it off, but the basic principle is trying to get that debt paid off as quickly as possible. So what should your loan or debt priorities be? Well, first of all, if you have non-tax deductible interest costs on lifestyle debt, on credit cards or lines of credit, you want to focus on paying that off as quickly as possible. That's not productive debt. It drags you down, and it's something to really pay attention to. Once you've paid off those loans, then mortgage debt would be the next area. You're not too concerned, at least not as concerned, because you're attaching that mortgage to an asset over time is going to grow. But because the interest costs are not tax deductible typically, you want to pay that off as a second priority. And then number 3 is mortgage and business loans that are attached to appreciating assets. So I have rental property, or I have stocks in my portfolio that I've used loans to buy, or business assets. That would be the last loan that you would focus in on in terms of your loan program. Now, let's talk about a couple of accounts that are really important for you guys. RSP accounts and tax-free savings accounts. And like I said at the beginning of the presentation, some of you already have these accounts in place, but let's just kind of go through and talk through the mechanics of these accounts. So RSP account. So an RSP account you can open at age 18, and these accounts, believe it or not, can stay in place until your 71st year. You have to be a Canadian resident for tax purposes. And the deadline for contributions to an RSP for this year is March 1st, 2023. So what's interesting about RSP contributions, as long as you get your contribution in by March 1st of 2023, you can deduct it on your tax return. We'll talk about that in a second on for 2022. Now, when you make an RSP contribution, for those of you who are not aware, there's a limit. Contribution limit is 18% of your 2021 earned income to a maximum of $29,210. And there's something called a pension adjustment. So if you have a pension plan, that is netted off against this number, right? So if you take, your earned income less or times 18%, and you have to take off this thing called a pension adjustment if you're part of a pension plan. So I'm not going to go into the specifics of that tonight, but that's just part of the calculation. What's interesting about RSP plans, and we'll talk about why you would do this, by the way. So I'm just going through the characteristics of an RSP, and we'll take a look at how it works and why you'd use one. If you don't use RSP room that you're building up, you don't lose it. It carries forward. And for most of you, that's actually great, because it may not, in fact, make sense for you to make RSP contributions right now. It's very much dependent on your income, so your taxable income. So typically what you see with people with RSP contributions is, it may make sense to take advantage of it, but when your income goes higher. So you might be at a certain tax bracket today, and your tax rate may go up down the road, and I'll show you an illustration of that. And then if you've made an RSP contribution, you don't have to deduct it right away. Again, that wouldn't be relevant for most of you, but if you make a contribution, you can defer deducting it on your tax return. So I want to focus more on why you use one, as opposed to getting into the weeds too much on how they work. Again, we'll talk about the mechanics, but an RSP provides tax deferred growth, and I'll show you an example of that. It means you're not taxed every year on your earnings. RSP income through a RIF allows for retirement income splitting, not really relevant for you right now, tax deductions, and when you pull money out of the RSP, it would be taxable to you. So once you put money into an RSP, ideally, you want to let it compound and grow over time and not pull it out prematurely. Okay, let's look at an example. You've got $1,000 of savings, and you put it into an RSP account with your financial institution. I'll talk about tax brackets in a minute, but let's say your tax bracket's 25%. That means that you're going to save $250 for taxes, for those of you that are paying taxes right now. So not all of you are paying taxes yet. So this doesn't sound very real or relevant, but eventually as you look at your pay stubs, it's going to become very relevant. So you have this tax bill, you reduce your tax bill. So by saving $1,000, you reduce your taxes by $250. What's cool about that is you might even take that $250 and reinvest it on top of the $1,000. So now all of a sudden you've got $1,250 of total dollars, and the $250 was found money from tax savings. So let's look at an example of how this can grow over time. So let's say that you're saving every year $2,000. And on this left column, this is an investment where you're being taxed. And over time, you're being taxed at that 25% rate that I talked about. And we're doing this over a number of years. This person's age 25 and they stopped investing at 55, so at 30 years. And their after-tax income was 3.75%. That was the return. Their portfolio over that time period grew to $1.3 million. Over here, we have investment two. This is the RRSP. We've got $2,500 going. Why? Well, we have that $500 value for tax deductions. We put that on top. So we're not just saving our $2,000, but the other $500 in tax savings each year. And we save for 30 years. And you can see we've got that 5% return. And the reason for that is on this return, we're not paying tax. We're deferring tax. So this return here, we're paying tax every year to the government, so it's less. And over here, we're deferring tax, so we're getting the full growth every year. So this account grew to about $2 million. So a significant increase over the investment that was taxable. So what you're getting is tax deferred growth, and then this account's taxable growth. Now, this $2 million does eventually come out as tax, but for most people, there's still a win here because the rate of tax they pay on this account will be less than what they were paying when they were working through their careers. But this is the biggest reason people make RSP contributions is they're trying to leverage off this higher return because you don't have to pay tax on the account, plus they're getting tax savings every year. So when you hear about RSP accounts, that's the main reason that people take a look at making a contribution. Now, the big question is, how does that compare to a TFSA? And when do I make an RSP contribution as opposed to a tax-free savings account contribution? So let's talk about that. To talk about that, we have to look at the tax brackets in Manitoba or Ontario or wherever you're living. And again, this is lots of numbers on this chart, but the basic idea is if your income is below $34,000, the first $14,000 here is basically exempt income. You're not taxed on it. On any income from $14,000 to $34,000, you're paying a tax rate of basically 25%. For every dollar you earn when you go to work, you're going to get deducted 25%. If your income is between $34,000 and $50,000, your overall tax rate is 27%. If your income, let's say, was from $74,000 to $100,000, your tax rate was 37.9% on that level of income. Now, keep in mind, it's not 37 on the whole amount. It's 37% on 74 to 100,000, then 33% from 50,000 to 74,000, and 27%, 34 to 50. So it's a blended rate overall. Okay, so you want to take this into account when you're making RSP contributions or tax-free savings account contributions. So I'm going to come back to these numbers because that's going to give us guidance as to which account we should use. So this is exploiting the tax brackets. So imagine if you're 20, getting close to 20 or maybe over 20, and this green line is your income. Here you are at 65, and you can see over time your income is going up higher and higher, and that's a pretty natural progression for many people. So they get into the workforce, they get some work experience, they get some increases in their pay, they get some job promotions, maybe you start a business, it's successful, and you can see your income's going up. And then eventually the income starts going down because it's very common for people, obviously, once they leave the workforce, their taxable income is going to be going down. Or, again, I won't get into detail today, but when people retire, it's the first time often they can begin to split their taxable income with their partner. And you usually see that people actually drop 1 or 2 or sometimes 3 tax brackets when they retire. Their total family income may not be a lot different, but their tax bracket is. So when you are at the lowest tax bracket, sometimes even in the middle tax bracket, we use this example. If your income is between, let's say, $34,000 or less, Or let's say you thought that your income would always be between 34 and 50. That's this green light right in here. You should be making tax-free savings account contributions. You should not be touching RSPs at this point. And the reason for that is the RSP creates a deduction and then it's taxable down the road. So we'll go through the logic of this. So if your income is in a tax bracket that always stays the same, you don't go over a bracket, you're always at 25% on my example, you want to focus on tax-free savings accounts. You don't want to touch an RSP plan. Now, once your income goes up above this red line, so I'm using a marginal tax rate of 38%, here we are here, your income is between 74 and 100, your marginal tax rates drop or jump quite a bit from 25 to 37. So as you hit this crossover point, you want to focus on RSP planning. Now, you may still have the cash flow to do TFSAs, but now an RSP makes sense because if I can deduct at 38%, for every $1,000 I put in, I'm getting back $380, plus growing money on a tax sheltered basis. And then when I retire, I'm pulling money out at 25%. I've leveraged off the difference between these two tax rates. That's where the RSP is very powerful. If your marginal tax rate is always the same, RSPs really aren't that beneficial. This is a relatively new thing. So if you talk to some of my age, talk to your parents, they would have had just drummed into them, make RSP contributions, do that as early as possible. That's not the case today. The case today is make sure you take advantage of your tax-free savings account. So for most of you, that's a really important priority. But certainly once you get into this 50 to 70 or 74 to $100,000 income range, RSPs definitely make sense because probably down the road, you can be at a lower tax rate. We're now going to talk about tax-free savings accounts. So again, for most of you, the RSP topic is not necessarily super relevant, but certainly once you get into those middle income brackets I talked about, now the RSP account becomes relevant. The tax-free savings account for, I think, all of you is super relevant. If there's one takeaway, by the time you get to age 18, you want to make sure that you set up a tax-free savings account. And even if it was $25 or $50 a month, my recommendation is begin contributing to your tax-free savings account. Why is it beneficial? We'll talk about just the mechanics. You have to be at least age 18. Contribution limit is for this year is $6,000. And for most of you, that's probably aggressive to get that much money into your TFSA, but that's the room. You never lose unused tax-free savings account room. So when you make a contribution or don't make a contribution, you always have that room carrying forward. So if you miss a year or you don't max it every year, you don't lose it, which is wonderful. Your room begins to accumulate at age 18. All investment earnings grow tax-free. Huge, huge, powerful win as it relates to tax-free savings accounts. All withdrawals from a TFSA are tax-free. So view the tax-free savings account as this miracle account to accumulate and build up investment value. You can pull it out at any time if you happen to need it for expenses that come up. If you're saving for a house or down payment, the TFSA is a great place to park money. And then for some of you, it might be a great place for long-term savings. But you want to make sure you have one in place and begin adding some money to your tax-free savings account to get that discipline going. The lifetime limit for people who are age 18 in 2009 when tax-free savings accounts were established is $81,500 is the current limit for anyone that was age 18 when TFSAs were first established. Okay, let's leave that. And I now want to go to investment planning, and we're going to talk about some basic investment principles. This is going to be relevant for all of you. They're just good foundational things to keep in mind. I find that in my own work with clients, sometimes they forget about these principles and it can make investing really difficult when they do. So let's cover them off. Okay. First of all, when it comes to investing for money that can be set aside for long-term investments, there is a huge cost to waiting. I remember when I started in the financial services industry with Royal Trust many years ago, and my brother was just beginning to work. I've been in the financial services industry for a few years, and I remember seeing a chart. It was Ralph and Sydney. And Ralph began saving money right away when he finished high school, and Sydney didn't start saving money until He had finished university and got some money down payment for a house and eventually got saving. And it was always shocking to me the difference that compounding investment returns made in that scenario. So our scenario is we've got someone with $2,000 per year of savings, years of growth, 40 years, and the delay was 10 years. The rate of return we used was 6% per year. So if you look at someone who just finished high school, let's say, and just started saving right away in this scenario, you can see that if they started now and didn't delay, the investment value in 40 years was $328,000 of investment value. If that same person or Sydney delayed 10 years because they were just getting their careers going and they had other expenses that they were wanting to look after, that waiting of 10 years led to portfolio growth of 167,603. The cost of waiting was 160,492. It's a huge cost there. So the basic idea for all young investors is don't take for granted the value of time and compound interest. It is a huge, huge leverage point for all of you. So to the extent that you can get those systematic savings going, we talked about pay yourself first. There's got to be some dollar amount that you could put away and leave it alone. And then this scenario, the person that started right away, by the time they got to age 60 or 65, if they did nothing else, they would have a nice little portfolio or a decent sized portfolio that could be going a long way to giving them long-term financial security down the road. So that's the one takeaway. Try not to delay, at least do something to leverage off time and compounding of capital. It really makes a big difference. So when you look at the difference here, the person that waited 10 years, the cost of waiting is they had to double up their savings. So to match the total portfolio value from the person that saved right away to the person that waited 10 years, when they got around to saving 10 years later, they basically had to double up their savings. So what took $2,000 per year to accumulate, by waiting 10 years, you had to save basically almost $4,000 per year. You had to double up your savings growth rate. You had to work that much harder for your portfolio because you couldn't leverage off time and compound interest. So the takeaway here for young investors, start early, keep something in their portfolio long term, let it compound and grow. For every year you defer, you have to work harder and harder for the portfolio in terms of what you have to save. And this example, to catch up, you had to double your contributions. Now, the next thing we want to talk about is the difference between loanership and ownership investing. So when you start saving money for your RRSP contributions or your tax-free savings account, there's two main investment categories that we think about. Loanership is one, ownership is the other. So let me just unpack what I mean by these two categories. So loanership investments would be things like savings accounts, guaranteed investment certificates or term deposits. Again, some of this terminology will be new for some of you. I'll kind of talk about it a little bit, but it'll be future, education and research and government bonds. Now, these things have one thing in common, and that's this. The characteristics of loanership investing is you are taking your savings from your cash flow and loaning your savings to a bank or financial institution. So you give them the money, you put it in a bank account or a savings account. And what they do is they give you a rate of return. So let's say that they give you 2% on your money. So you give them 1,000, they'll give you 2% per year on that investment. And what do? Well, they loan out the back door. So they do mortgages, maybe at 4%, and car loans at 6%, and other loans in their portfolio, lines of credit. And so they're making money on your money. So the banks make money on what's called spread, the difference between what they pay you, the 2%, and what they're making. So they'll make 2 or 3 or 4 or 5% more money on your capital. You're okay with that because they're guaranteeing to give you this money, and then they cobble the money away and make money on your money. And that's the basic characteristic of ownership investments. Whenever you have a savings account, a term deposit, a GIC, you're making a loan to the financial institution or the government body who you're buying the bond from, and they're paying you interest and then committing to repay that back to you at some point. If it's a savings account, they have to pay that back to you right away. You put money in your savings account today, you come in tomorrow, They have to pay you back. And that's why the interest rate is low. It's a demand loan. You want your money right away. If you bought a GIC that doesn't mature for 5 years, they'll give you a higher rate. So we'll take a look at rates in a second, because you're locking your money up. You can't come into the bank the next day to get your money. That means they know they can lock the money up when they loan it for longer periods of time and make more money on your money. So that's basically loanership investments. And we'll talk about what's good and bad about loanership investments in a second. Okay, so this chart here, I just pulled this off today. Guaranteed investment certificates with the Royal Bank of Canada. So I could walk into the Royal Bank, and what a GIC is an investment where you lock it in for a period of time. So you don't have access to the capital until it matures. And for every year you lock it up, you get a higher return by the bank. For a 1-year term, they'll give you 1.25%. For a 3-year term, they'll give you 1.75%. For a 5-year term, they're going to give you 2.5%. And on it goes. On their savings accounts right now, they're giving you 0.3%. Why only 0.3? You can take that money out anytime. 5-year term, they'll give you 2.5 because you can't get that money for 5 years. At 5 years, they pay it back to you. They can loan that at 3.5%, 4.5%, or 5.5% and make more money. Okay. What's really good about loanership investments is that they don't fluctuate. Whatever you put in, you get back for sure when it matures, and you get an interest rate, particularly for these kinds of investments like GICs, you get a guaranteed rate every single year. That's awesome. Why wouldn't we put all our money in GICs or term deposits? Well, one of the reasons is we live in a world where there's inflation. And inflation robs the purchasing power of your investment over time. It's very subtle. It sneaks up on you, but it has real impacts. So when you look at inflation, I'll give you an example. So a basket of goods and services. So we have something called the Consumer Price Index. And let's say we had $100 of, a basket of goods and services back basically 100 years ago. Okay, so we're going back, no more than that. So basically you're looking at 108 years ago, 1914, $100 of goods and services. And if you look at the same goods and services today in 2022, that same basket would cost us almost $2,500. So what is inflation? It's increasing costs of goods and services over time. I'm not going to talk about what drives inflation today, but the most important thing is you need to realize that because we live in a world of inflation, almost certainly we'll have inflation in the future, you need to invest in such a way where your money keeps in pace with inflation. So that average a 3% per year inflation rate over time. So here's the rub. This is what we have to worry about. So let me just give you a couple more examples to make this real. Average car price in 2000 was $21,850. The average car price today is about $47,000. If you look at the average home price in Winnipeg in 2002, it was $104,000. Average home price in 2011, $256. Average home price 2022 is $387. And that's just the average. Obviously, it's a lot more in certain areas, but that's inflation. This is the increasing costs you have to deal with. So here's the problem with loanership investments. They're good places to park money if you need access to that capital over the next 1, 2, 3, 4, 5 years. Right? If you're saving for a down payment on a house or a specific expense coming up, then it's okay to park your money there because you don't want to worry about losing money or having fluctuating returns on your portfolio, right? You want guarantees. So the problem, though, is there's a long-term problem. Many investors don't realize it because it's subtle, but if my GIC was paying 2% and inflation averaged 2%, how much am I making in after inflation dollars? 0. So I'm really effectively not making any money because we live in a world of inflation. So that's called GBS. Anyone know what GBS means? Going broke safely. Okay, so it's not market fluctuations, but it's why people increasingly feel like they have less spending power over time because they're investing in such a way that their investments don't keep in pace with inflation. The one takeaway, loanership investments Great for short-term money needs. Horrible for long-term money needs, because you're going to lose your ability to purchase goods and services because you're not getting enough return. That's the main takeaway here. Okay. So let's go to ownership investments. It could be stocks, stock mutual funds, stock ETFs. You could put business equity or business investing in there, and real estate. Now, for today's discussion, I'm going to focus on stocks and stock ETF type investments, because that's practically what you can do within an RRSP account or TFSA, as an example. So what are the characteristics of ownership investments? Well, basically, think of a business generating income, and they subtract their expenses, and the difference is a profit. So I'm being very, very, very straightforward and basic here, but ultimately, that's what business is about. Business is about generating profits, having more income than expenses, and generating surplus cash flow and profits. Now, how do they generate growth or profits? Well, businesses will do that through increasing their sales, through sales and marketing. They'll do that through capital investment, buying more plant and equipment, increasing the productive capacity of their facilities. It could be research and development, doing research that gives them a competitive advantage in the markets that they work in. And it could be acquisition, buying other businesses and scaling up, becoming larger and more efficient. There's all kinds of ways that businesses can generate higher profits. These are just some of them. Now, why would we consider ownership investments for our portfolios? Well, the main two reasons would be, number one, my little graphic here. The green here is the value of the investment or business over time. If a business is managing their cash flow and doing all these things for growth, over time, there's a potential that that company is going to grow more and more value over time. In addition to that, these red arrows represent dividend payments. So I actually can make some income while I'm holding and investing in this ownership investment or stock. It's the best of both worlds, right? I got income and price appreciation over time. Now, a great business has pricing power. And what I mean by that is, we talked about this world of inflation. And if I have ownership investments, I'm going to lose my ability to keep in pace with inflation. Great businesses protect you against inflationary pressures. You see this red arrows going up over time, because what happens with businesses who are dominant is, as inflation goes up and their input costs or cost of operating goes up, what do you think they do typically if they're dominant in their industry? Well, they'll pass on those higher costs to their consumers. So their cash flow goes up, their overall profit goes up, their ability to generate more dividend income over time goes up. And as they have more cash flow and profitability, their share price is going to go up. So what you find is, with stocks that are very dominant in the industries that they serve, not only will they grow above the rate of inflation, but you'll get income along the way. That's far superior to holding a bond. So the minute your time frame goes past 5 or 6 years, you want to begin thinking about stocks for your portfolio, so you can get the best of both worlds, which is income and growth. Let me give you some examples. This is the Royal Bank of Canada. The banks are almost like legalized monopolies. This chart shows you the bank share price going back. Well, here, this one says 2006. So the bank share price was $47.84. And you can see that recently it was $146. Okay, so that's not bad price appreciation over that time frame, right? So it grew over time. And the dividend yield in that stock right now is 3.74%. Remember I showed you those GICs? They're paying 1.25%, 1.5%, 2.5% if you lock away your money for 5 years, and savings account were 0.3%. Here the Royal Bank's paying a dividend or cash flow of 3.74% per year, and over time you're getting this growth. Now, it's not without some fluctuations. We'll come back to that in a minute. Here's another company, Canadian Tire. Probably most of you have gone into Canadian Tire once in a while. Back in September of 2001, the share price was $24.80. And when I checked it recently, it was about $186. And you can see the dividend yield here is about 3%. Now, again, there's fluctuations. It's not always going up, but overall, there's some decent price appreciation on that stock. Here's Netflix. There's an important lesson here. What do you think about Canadian Tire? What's it selling? Consumer staples. Kind of boring, right? Royal Bank, banking services. Kind of boring. You know, these are very, very strong companies with strong balance sheets for the most part. Now we're at Netflix. Look at the trajectory of this share price. So back in 2005, it was $1.62. It hit a peak of $645. In September of 2017, it was $174. And look at it today. It's just like plummeted. And I think a lot of you know, so you're looking at $174 share price. And, you know, not that long ago, it was trading at $645. So there's a lesson there. I don't have to focus on it too much, but there's a business where it's in a space that was really impacted by COVID. So, you know, lots of people were getting their Netflix accounts or maybe leveraging off somebody else's Netflix account, and their subscriber rates have gone down dramatically. They're going through some problems right now. And this is the downside of stock ownership. So it's not all great. Yeah, you can get income and you can get growth, but you've got to find ways of reducing some of these kinds of risks over time, right? So the longer your time frame, the less an issue. But this, of course, is a big issue for any investor. That's a pretty big decline. And then this last chart I'll show you, this is the Vanguard S&P 500 ETF. I'm not going to talk about ETFs in any detail. I'm probably not going to have time tonight. I'm going to do a follow-up video to kind of unpack mutual funds and ETFs for you in more detail. But this is an investment that all of you can purchase. You can purchase, you know, little bits over time. And what this investment does is it buys the 500 largest companies trading on the stock exchanges in the US. And you can see going back historically, you know, this price of the stock back in 2013 was 121. So ETFs trade like stocks. So they took the roll-up value of all those stocks. It's $121 per share. And if we go to the peak here, it was about $412 per share on this chart. Okay. Not without volatility, but it's done pretty well. Of course, the US market's been very strong. The dividend yield is 1.34. Now, why is the dividend yield so much lower than those other examples? And the reason is, if you have a high dividend yield, I was showing you a single stock that's known for paying out dividends. That's part of their appeal to investors, and they try to maintain decent dividend payouts. This investment has all kinds of companies. Some companies don't pay dividends. They reinvest all their profits back into building the business. And then other businesses do pay dividends. So when you merge them all together on this investment, it brings down the overall dividend yield at 1.34%. But that's actually about the same rate you get if you locked in a 2 or 3 year GIC. And then you get this growth rate. And over this time period from 2013 to basically now, it's a 14% compounded return. Now, this has been a very good period for the US market, but the S&P 500 has been a good long-term place for the last 60, 70 years for investors for the most part. What I'd recommend you consider if you want to start investing in the stock market is an investment like this. So the Vanguard S&P 500. That gives you exposure to an investment that trades like a stock, but it gives you lots of diversification. It's more difficult to get hurt if you make the wrong decision, and it gives you broad exposure to the market. So for newer investors, I would recommend something like this. Now, it doesn't mean you don't buy individual stocks. And if you want to do that, you open up a discount brokerage account or an account with your advisor or your parents' advisor, and we can help you with that. But this would be a great option for beginning to invest little bits and bytes into the market. This really summarizes a lot of what I just talked about in the different comparison between ownership and loanership. This is another chart that goes from 1982 to 2015, and it's $10,000 invested. And we're looking at, again, the S&P 500. At the top here, we have the MSCI World Index, which is a global index. That's global stocks all around the world. the S&P TSX index, which is the Canadian market, and then 1-year GICs. And what this does is it looks at the after-tax, after-inflation returns of each of these categories. Remember I talked about that earlier. This chart's netting off all those different aspects. And what you find is on an after-tax, after-inflation basis, the US market was the strongest. So it delivered $91,000 of total value. The global markets delivered $59,000 here. Canadian market, there's a little bit of a clue here. Now the Canadian market's doing well relative to a lot of other global markets today because we're overweight energy stocks. But generally speaking, over the longer term, the Canadian market has not been as strong as these other markets. So it delivered 45,000. And look at the 1-year GIC, 9,000. Actually had less value than when you started. So 1982, there's the GIC value, didn't make any money. And here are the stocks. So this is a great way of encapsulating the whole discussion. Why would you have stocks? You're trying to grow your capital. What's the downside of stocks? Look at this fluctuation, right? So there is fluctuation. That's a trade-off. And we'll talk about some principles for handling fluctuation. This is another way of looking at it. Yeah.
Sorry, just a question came in. Why wouldn't you invest all your money into an index fund since it covers such a wide range of business and has a high return? Is there a real risk of it failing?
Yeah, I don't think there's a reason why you wouldn't do it. I think for most investors, buying an index fund is a great way of growing value in the stock market. I think it's very compelling. The minute you start going in the direction of specific stocks or specific sectors of the stock market, because you can buy investments that just buy commodities or energy or healthcare or financial services, now you're taking the risk of getting your timing wrong. So I think for most investors, where they're trying to participate on the long-term growth, but they don't want to worry about the timing, then an index fund that's broad, the S&P 500 was the example I used there, would be a great option for most investors, right? That's just a great way long-term of accumulating capital. So this is another way of looking at it. This is 1950 to 2012. Again, you can see a pattern here. US large cap stocks, 11% per year over that time period. That's this here. So if I invested a buck, it grew to $670. If I invest in small cap stocks, there's more volatility, but they grew to $2,600. And the Canadian stocks, $364. So it's almost a 10% compounded return, 11% compounded return, 13%. If I look at GICs over that time period, actually we're pretty good over that time period. We had some high interest rate periods. They did 6.8. But there's a big difference here between the growth on the stocks over time and your GICs or T-bills here. Lower risk though, you're not seeing the fluctuation, right? That's a trade-off. And that's why I say you want to compartmentalize your portfolio between money that's needed in the shorter term, less than 5 years, less than 3 years, and money that's not needed for the 5 years plus in your portfolio. Okay, so I hope that is relatively clear. The reason I showed you the individual stocks here is that's what an index fund or a portfolio manager is trying to leverage off this. And what they'll do is they'll buy a basket of stocks in different sectors and try to manage that basket to try to reduce some of that fluctuation for you. In an ideal world, getting market returns, but for less total risk. It never works out perfectly that way, but that's the goal that most portfolio managers try to achieve. But you have to be willing to accept some level of short-term risk when you go into the market, and time is the investor's best friend. Here are the 3 categories, and you'll be getting a copy of this presentation, by the way. So most of the investors that we have are in big cap stocks. So those are companies with market capitalization of more than $10 billion. You have mid-cap stocks and small cap stocks. These are smaller companies. What comes with that is more growth potential, but also more risk of fluctuation. So one of the really important things when it comes to financial planning is when you do a plan, you try to figure out what kinds of returns do you need to achieve your financial goals. Over time, that's a really important exercise to go through. Most people don't want to take on more financial risk than is required to achieve their goals. As they get older, that's a really important priority for them. So you don't want to take on excessive risk, but you want to take on enough financial risk in the short term to generate the long-term performance you're looking for. Okay, so that's loanership versus ownership. How do you choose? I just talked about it. There's amount of risk you want to take on, your time frame, what your financial goals are. I think the one thing that I'd like to see all of you do as soon as possible, it'll be age dependent, is make sure you got your TFSA, make sure you're making monthly contributions to that TFSA, and make sure some of that's going into an index contract in the market, and you're just letting that money run. Leverage off time and compound interest. Have a piece of your portfolio where it's sacred. You're never going to touch it. It's your long-term capital, and you let it run, and you invest every month and take advantage of the opportunities that are there in the market automatically. You don't even have to think about it. Okay, so why stocks in your portfolio? So stock investing is the way to go. What's one of the challenges? This image really shows one of the challenges. It can get scary at times. So I'd say investors today, I'm not sure how much you're paying attention to it right now. The markets are going through some volatility for sure. And a small percentage of investors respond to that volatility in the right way. And a large percentage of investors do exactly the wrong kinds of things. So you may have heard this in your circle. You know, the best investment strategy is to sell high and buy low, right? That makes sense. When the bargains are on, that's when you want to buy investments. And when they're getting expensive, maybe that's time to trim your portfolio and take some profits. But investors generally do exactly the opposite. No one admits to that, but that's what they do. When markets are in turmoil, and we see it in the investment industry, you can see cash flows leaving the market. And when the markets are doing well, you see cash flows going into the market. And so part of the challenge of investing is adding on those dips, maybe snipping some profits or paring back the portfolio on the highs. You hope both your advisor, but also your investments securities would do some of that for you. The other thing that makes investing in the stock market difficult, and this is a reality for all of us, we work hard for our money, and we have to recognize that this is a reality. When the market's going up, you're optimistic. Your portfolio is growing. You're excited. And then we go into a bit of a downward cycle in the markets. Now there's anxiety, there's fear. And then we see drops in the market. And you see, and we sing it right now in the market, panic, capitulation, despondency, depression. And then eventually the market begins to improve and there's more optimism. And like I said, one of the real problems with investing is people are just on this cycle of investing that's very emotional and they're not objective and they often will make bad decisions. And that leads to some consequences. So here's one of the consequences. Now, this is an older chart. It goes back a few years ago, but it went back from, I think it was 1992 to mid-2000s. And what it did is it looked at the average return of stock funds. The image isn't super clear here, but average stock fund in Canada over that time period averaged 8.2% compounded returns. And the average stock investor buying those same investment funds in Canada averaged 3.5% per year. So they were buying exactly the same investments, but their performance was dramatically lower. And when IFIC, the Investment Funds Institute of Canada, did the study, they referred to this as the investor behavior penalty. People were selling at the bottom of the market, buying at the top end of the market. They just weren't exhibiting any discipline. Had they just bought those investments and held them through the cycle, they probably would have done a lot better. That's the biggest challenge for retail investors. So how do you make sure you're not on this side of the balance sheet, that you're actually getting the investment returns that are purported to be there in the stock market? First of all, don't succumb to, drive-by information from family and friends, right? Whether it's advertising, your neighbors, the internet. There's all kinds of information that comes at us. It can be very confusing. You need to become educated on the topic. This is the first part of that, but become a lifelong learner as it relates to investing. It doesn't mean that you do it and be yourself directed all the time. You can delegate a lot of this to an advisor or a money coach to help you. But the more educated that you are, the less likely you're going to make knee-jerk, low probability decisions on your portfolio. It's absolutely critical. You don't have to become an expert, but there's some basic principles you need to be mindful of. And we'll talk about a few of those tonight. So one of the principles is outlined in this particular chart. So remember I talked about all that volatility in the market. This chart kind of summarizes the expansions in the market and the downturns. This goes back to 2008, and that was a very tough time in the market. The broad markets were down 52% in the 2008 financial crisis. So it wasn't fun to be an investor back then. And then post 2008, the green is the increased returns over that time period. So the correction in markets at that point, they went down 52% over 14 months. And then the market went up 78 months, 260%. And then we had another downturn of 13% over 7 months. And then the market went up again over 32 months. It was up 69%. We had another downturn of 18%, then went up about 46% over 14 months. And of course, the pattern repeats itself. So when you step back, what you see is the expansions are way more frequent than the downturns. The market is actually in total days up 70 to 80% of the time and down 20 to 30% of the time. So out of a 10-year cycle, you'll see 2 to 3 losing years, and the rest will be positive. But when you watch the news, all you hear about is the red, because that sells circulation, it sells eyeballs, it sells interest, but it's not relevant. In the midst, it's relevant. What you try to do during these time periods is be a buyer, because you know that these periods are eventually going to come. So any investor that has a discipline to buy here when there's corrections in the market is almost always rewarded at some point with above average returns. Right? We're going through that time period right now. Okay, so out of a 10-year period, you're going to have 2 to 3 losing years, but mostly positive years. This is another really interesting chart about what to expect with volatility. Between 1980 and 2014, the red dot was every single year in this chart, the S&P 500 was in negative territory. There wasn't a single year where the intra-year return at some point wasn't negative. And yet, the majority of the years were positive. That's the blue bars here, with some negative years for sure. But this goes back to the averages I just talked about. You're going to have way more winning years than losing years. This year in 1987 is a really good example. I was pretty new to the industry. I was working for Royal Trust at the time. And GIC rates, those ownership investments, were paying about 6, 7, 8%, depending on the term. Royal Trust at the time had a lot of clients in mutual funds, but they were pretty unsophisticated investors. And it was called, Black Monday. But 1987, the markets dropped quite precipitously, over 30% within a 2 to 3 day period. None of those investors had had any experience like that before. They were all risk-averse investors. And there was panic. I remember walking in the branch one day, and there was a lineup coming into our branch. People wanted to cash out their investments. The crazy thing is, mutual funds at that time, that's still the case today, they get valued at the end of the trading day. So just because you put your redemption in first thing in the morning, it didn't really make any difference as to what the final price of your investment would be later in the day. But anyway, people moved out of their investments, bought a GIC, took their losses here, big loss. Look what happened at the end of the year. By the end of the year, the market was positive that year. So that gets back to that emotional reaction to things. Now, that doesn't always happen, but that was very instructive to me as a younger advisor at that time. Now, this chart is going to be one of the most important charts for you to keep in mind in your young investment careers and moving forward, putting money away. And this is the notion that you can time the market. It's critical that you really, really zone into this. When you watch the news and you read information, there is a lot of information where market gurus, that can read the economic tea leaves are going to be able to tell you what's going to happen with the markets. And that's a constant drumbeat. But the question is going to be what is the probability that they're going to be accurate with some of the information the information they're sharing in that moment? And I'd say that for most investors, they're not going to be accurate with their prognostications. Let's take a look at it. So you and I have $100,000, could be $1,000, but we use $100,000 in this example. And we put the money in the US stock market for 30 years. So we're going back 30 years ago to today. If we left that money in the portfolio and stayed fully invested and reinvested all those dividends I talked about, the portfolio grew to $2 million. And we earned 10.6% compounded. Now let's go over here. And what if we missed the top, well, first of all, 10 days. We are the market, the 10 best days. Our portfolio grew to 953. We compounded at 7.8. It's a pretty big difference. And if we missed the best 30, or let's say 25 days, we compounded our portfolio at 5.1%, and it grew to $445,000. Now, what you're seeing here is a bit of a pattern. There's not a lot of days to be out of the market when it does well that would drive most of the return. A relatively few number of days drive most of the return in the market. It's actually very concentrated. So here's the problem. We think we can be really tricky and fancy with the portfolios. We're reading the headline news, the economic news. We think that the markets are about to correct. So we become more cautious. We know we have to have money in the stock market to cope with inflation to get decent returns, but we think there's too much risk right now. Let's pull some money off the table, or lots of money off the table, and go to cash for now. We'll wait till the news gets better. When we get through this crisis point, then we'll put money back in the market. Here's the problem. Once you leave the market, it's going to require a lot of confirming or positive news for you to move back in. So keep in mind, you do have to have stocks in your portfolio, in my example, to get the returns that this investor wants. They have to go back to the market at some point. Most people will miss the best days in the market because they need so much good positive news before they reallocate their capital. Let me show you an amazing chart. This is between 2008 and 2021, and we're looking at the best and worst days, the 20 best days and the 20 worst days in the market. So this is going back to sort of 2008, 2009, 2011-12 period, 2020 coming through COVID. Now, what you see here is the best and worst days are pressed right up against each other. So what ends up happening when people go through this red period and they're waiting for the bad news to pass, when are they beginning to allocate capital? They're not allocating capital here. They're allocating capital here. So they're missing most of the recovery days that are happening in the midst of all this volatility. So the big takeaway when you begin building a stock portfolio is when you go through those tough days, maintain your positions, as much as possible, invest back into those positions, and realize that it's very difficult to time the market. If you move out of the market during periods of peak volatility, in all likelihood, you're going to miss the recovery days that will help to recapture the value in your portfolio. So it's a really, really important concept. I think sometimes people struggle with it because it seems to be unsophisticated. What do you mean? Just, hold on. Aren't there some more sophisticated strategies we can engage in? And yet, to be a successful investor long-term, you got to have discipline. You got to push against the anxiety. You've got to buy during these periods of time, and you don't want to be a seller during peak volatility when the headline news is really negative. So this is a good basic slide. Vanguard put this out a few years ago. So this gets back to building a portfolio, designing a portfolio for yourself. And when it comes to actually investing money, there's a lot of pre-packaged solutions for investors to make this easy. So what happens is when we begin mixing up loanership and ownership investments, you see at the top of this chart, it looks at the time period between 1901 and 2016. And this is a mix of bonds and stocks in each portfolio. So over here, you've got 100% stock portfolio. And over here, you've got, let's say 100% loanership or bond portfolio. So, it's a long period of time, but basically what it's showing you is that over that time period, a conservative portfolio generated returns of about 4 to 5%. Okay. Now, keep in mind that through some of these periods of time, interest rates were pretty high. We might be going back into a time period like that. As you go along this chart, you're adding more stocks to your portfolio. So the stock portfolio here are just doing 9% compounded between 1901 and 2016. And And yet here you can see the trade-off. So in a 100% stock portfolio, you could have in any given year, you could have minus 19 to plus 36% in terms of performance. The average over that time period was 9, but you can see a lot of swing potentially. That's the risk you're taking on, right? It doesn't mean loss of capital, but it does mean there's this fluctuation factor. This is at the extreme end, but it could happen. And then you go over here and you can see that this portfolio has much less total fluctuation on it, okay? So when you're designing portfolios, you just want to keep in mind, how much risk do I feel comfortable with? What can I live with? Again, for most of you at your ages, there's some part of your portfolio that I think could be 100% growth. If you don't need it for the next 6, 7 years, just put something away every month in a good index contract to grow your portfolio. This is another way of looking at risk. This is an investment solution that we've used in the past, but this is a really good example. So this portfolio, this is for a 10-year period ending December 31st, 2020. So 100% stock portfolio, it generated basically 9% on average to 8.5%. That was the average return. Look at the 1-year fluctuation. So the 1-year maximum fluctuation was minus 18 to plus 46. Over 3 years, it was minus 4 to plus 20. Over 5 years, it was break even to 18% per year. So what you see is with portfolios, we refer to as reversion to the mean. The longer the hold period, the more the portfolio comes into the expected return range. So over 10 years, this portfolio did 5.3. Did that undershoot the client's expectations? For sure. But they still did double the GIC rate return over that 10-year period. But it was a rough ride, right? This other client was compounding at 18% per year for the first 5 years. They were ecstatic. Now, here's something that's really important in this chart. Investing is a lot like farming in the sense that when you build a portfolio or you work with someone, they can do everything right? If you look at farming, the right inputs, great land, best technology, research, science, farmer does everything right. And yet there can be great variability from one year to the next because there's factors they can't control, right? There's commodity prices, there's rainfall, sunshine, hail, right? Those are extraneous factors that any farmer knows are risks. So they could do everything right, but they may not get the performance out of their farm that they would have liked. Investors like that investing is like that as well. You can do everything right and be disciplined and have great strategy, but there are extraneous events that will impact your performance. And you want to make sure that over time, you're really smart about how you assess performance. Portfolio performance is sometimes just the fact that you invested in a year that was not a great year and no one could have timed that. And then other years you invest and you have great performance and you think, well, you must be genius. No, probably you were lucky in that year. And so what happens is over time, portfolios will come into their average expected returns. Some years you'll add money when the market just takes off. Other years you may add money when it goes through a struggling period. This is why it's so important to average consistently into the market. So one of the biggest challenge for investors is, we see clients having inheritances, pension transfers, real estate sales. I've got a client that just recently sold a business and there's large dollars coming to cash and they want to invest the money. And I always say, we need to be very cautious and judicious. We don't want to be adding all this capital to the market right now because no one really knows whether the market is low to go lower or low to go higher. In the short term, there's variability, but over the longer term, if you invest consistently, you're not going to worry about that variability. Everything tends to even out over time. That's the power of time, compounding, and consistent contributions to your portfolio. Okay, so that's hopefully a little bit helpful. So how do you do successful stock investing? Know your objectives, obviously, know your time frame, understand your own unique risk comfort level. Timing the market is futile. You can reduce risk through diversification. Don't have everything in the stock market or in one market. If at all possible, consistently add to your portfolio to average in. Sometimes it does make sense to profit take along the way if we have extraordinary returns over a period of time. Rebalance the portfolio along the way. And for most people, having some advice or coaching at some point probably makes sense, because it's very hard for people to be objective about their own money. So, sometimes having somebody else in the corner helping you to make those decisions increases the probability that you'll make the high probability decisions to be successful with your investment portfolio. Okay, now I think that we're going to kind of close out here. I've covered a lot of material. You guys have been very patient. What I'm going to do is I'm going to prepare a follow-up video that's going to talk about investment funds. I'm going to talk about ETFs, and you can take a look at that at your leisure. I think you'll find it a good supplemental material to what we've covered off today. So let me stop sharing my screen. Okay.
Sean, you did have a question come in while you were talking.
Okay.
I'll go through that. Do you see it there?
Yeah, so this is, you don't have to interrupt, but are there some guidelines for percentage of your income that you should allocate to funds, savings, etc.? A budget? Yeah, that's a really good question. So is that the one you're referring to, Milan?
Yes.
Yeah, so it's sort of why I said at the beginning of the presentation, when we looked at cash flow, it's almost like Stephen Covey had this really good analogy as it relates to just, life purpose and goals and what we're trying to achieve, because we only have so much time in our lives, right? So where do we focus our time? And I think investing and cash flow is the same way. So I think you want to, before you start spending your money, as you get into working and your careers and getting cash flow coming in, you want to start putting some of those non-negotiables in that jar first. So what are some of the negotiables? I would say that any individual that can strive to get up to that 10% of cash flow into their savings program, that should be a really important goal. So we look at cash flow, there's a few things that need to be looked at when you look at your budget. So you've got systematic savings, strive for 10% of your cash flow. I think you do want to, I talked about charitable giving or charities. That may not be a lot initially, but try to have some amount going to that. Start putting those rocks in that piece right away. And that might be 10 or 15 or 18% of the cash flow. And then try to manage your budget based on that net cash flow. How it breaks down between discretionary and non-discretionary, that's going to be an evolving kind of experience. But I think that where we get in trouble is that discretionary spending. But if you've already put the rocks in that cash flow jar and you set a priority for those things, then they're going to run by themselves. So if you make some tactical mistakes along the way with your cash flow, maybe took on a little bit too much debt, or you're spending a little bit too much on discretionary expenses, if you've already set aside money for those important cash flow items, then it's still going to work out for you over time. I'll give you an example for younger clients who are just starting out, they're now in their careers. One of the things I say to them is make sure that you think about the old man or the old lady in the sense that eventually you will be 55 or 60 or 65. So what do you need to be doing right now at 25 or 30 so that by the time you hit age 60, your long-term income security is looked after? It seems like a long ways away, but you ask anyone who's 60, it seems like yesterday they were 25. So dial in that number. What do you need to be putting away every month so your long-term income security is looked after? I think that's a really important priority once someone gets in the workforce and they're starting to work. Then what you do with your cash flow after that will be a bit of a negotiation. You want to make sure that as you take on debt, mortgage debt would be the biggest one probably, that you're really looking ahead and you're not allowing those debt decisions to get in the way of good financial planning. So again, when I talk about long-term income security, the mistake that people make is they begin accumulating debt and it sucks up cash flow to the extent that they're not able to look after long-term savings. And then they get into this debt repayment cycle where, they're paying down debt, they're on this treadmill, they never get around to doing long-term savings, but they're paying down some debt. And by the time they get to 55, they've been paying down a lot of debt, but they never got around to tapping into time and compound interest. That power, they never tapped into it because they never got around to it. So it's really important before you take on debt, car loans, mortgage loans, that you kind of look at the ripple effect into the future before you make those decisions. And you can do that on your own, or you work with an advisor or family friend who's well versed in the area to help you, project out what the impacts of those decisions before you actually make them. That's a very long-winded, convoluted answer. I do think that it's important to track expenses from time to time to get an understanding of how much of your cash flow is, basic non-discretionary and how much is discretionary, right? And that's a really important piece, because the basic non-discretionary part of that should be your savings. That shouldn't be looked at as discretionary. That should be part of your basic operating budget. I think we'll end it there, everyone. Thanks so much for taking the time to sit on this presentation. This has been a good learning experience for us, because too much of our time is spent with people who are now 55, 60, 65, and they're dealing with different kinds of issues. And when we were approached, when Ian and Pam, when you kind of floated the idea, which I thought was a great idea, is for all you guys on this call, the more you think about these long-term issues, the better it is. And if you have follow-up questions for me, just zip us an email. We'll try to get back to you. But hopefully you found this, somewhat helpful. That can be a primer to begin thinking about some of these things, and it might prompt some additional questions.